check the markets here as we wait for this afternoon's Fed decision. Of course, the news conference from the chair. Nasdaq's red. Everything else is green, but certainly there feels like it's a wait and see. Liz, nice to have you back. The 10-year yield, 4.20.
Yep.
Okay, that's the highest since September the 4th. Piper Sandler today says, is the 10-year at 4.25 the line in the sand for equities? So is that the biggest wild card today? What rates do on the back of whatever the Fed says?
Yes, but I'm going to add some nuance to that. So there's some technical resistance on the 10-year at 4.25, somewhere between 4.25 and 4.30. But the actual resistance for equities, in my opinion, is 4.50. So we still have some time until that happens in a durable way. But the nuance is, after every cut that we've had since September, yields have risen. We're actually only 9 basis points on the 10-year above where we were when they started cutting this September. Last September, when the Fed started cutting, yields rose from that September cut through the end of the year by 100 basis points. So the drama that we're sort of hearing about yields being up during this cutting cycle, I think, is a little overdone. And I think we are still pretty far from that scary threshold for equities. But the verbiage that they talk about into 2026, if it's very hawkish, I think that matters much more than anything about the rate decision today.
Yeah, you'll get an outlook today, of course, to Liz's point. Joe, what is the line in the sand then for equities? Where people assume that stocks are going to rally into the end of the year because of FOMO, chase for performance, Santa Claus rally, what have you. Is there a line? What's the number?
I think the most important thing is if we see the return of elevated bond market volatility. If you think back to 2022, the challenge in a very punishing environment where we were raising rates was you had a 10-year trading range that year of 285 basis points. So far in 2025, the 10-year trading range is only 95 basis points. If we are going to make a return in 2026 into an environment where you have elevated bond market volatility, that is going to be a problem. That's going to be a headwind. In the near term, I do think I've heard so much about the various types of disposition that the Federal Reserve is going to take today. Hawkish cut, Chairman Powell coming out, maybe not giving strong guidance because ultimately he doesn't possess the data. I think it's priced into the market. I really believe that. I think what's important.
Wait, hold on. You think hawkish cut is priced into the market?
I do.
Okay.
I think it's priced into the market. And I think the bulls should be excited at this moment, and let me share with you why. You have in front of you today the Fed announcement. You have the Oracle earnings announcement. You have Broadcom tomorrow, and then next week you have the jobs report. For the better part of the last 10 trading days, we have been sitting in a very tight trading range after the pre-Thanksgiving rebound that was working off all of the short covering that we saw in the month of November. So we're sitting kind of at the top of the range. I think the market has its eyes on the 69.20, October 29th intraday high. And I will be, over the next several days, I won't be here. Kevin, I'm out. I'll be in front of the screen trading, and I'll be trading it from the long side because I think we're taking that high out.
Okay, Carrie. Tell us what's on your mind as we wait for this decision. We wait to hear from the chair. We wait to get the outlook, and we wait to see how the market reacts.
I also agree that we expect there to be a cut and that the verbiage will be hawkish. We just hear and see endless commentary from various members of the committee that they're not sure whether there should be a cut or not. And the market believes that, understands that there's a mixed view on the Fed.
Okay, so you would agree with Joe that you think it's in the market.
I think that's in the market. What isn't in the market, given that we're at a high, we're basically at an all-time high.
Well, like 1%.
Right.
We're 1% or so on the S&P.
And on the NASDAQ, less than 2%. So what we don't know is whether Oracle and Broadcom are going to give some type of guidance, which is very disappointing. I doubt that. But if that were to be the case, I don't think that the hyperscalers will take it well. I think they'll be nervous, or their owners will be nervous, and they'll be selling pressure over the next few days.
Remember,
but that's happened before.
Remember, Jenny, the last time the Fed had the meeting, we had mega cap earnings. So it was, you need to listen to the chair. You need to see what they do, what they say. Now you need to do the same. And we don't have a mega cap earning, but we have one that feels, if not equally as important at this moment, right now feels pretty darn important in Oracle for this trade.
I agree. And I think it's interesting how everyone here, myself included, thinks that most of the verbiage is already priced into the market, thinks that a hawkish stance is priced in. And we're thinking about last year, too, where they cut 100 basis points. And what happened? The 10-year went up. And now they've cut a bunch this year, and we're basically flat. Not exactly flat, but basically. So I think what Oracle says, what Broadcom says, I think that's going to be way more important as an influence in the market over the rest of the week than anything the Fed says.
Well,
I mean, I'm getting ready to take a nap at 2 o'clock.
Okay. Great. Thank you.
You're welcome.
Steve Liesman, our senior economics correspondent, is going to, obviously make his way towards the room where it's going to happen. He's in our bureau in D.C., it looks like right now. All right, so we have two things that are front and center. Not only the meeting and the news conference, the outlook, but the interviews that we are learning are taking place with the president, and the first one will be with Kevin Warsh. So maybe it's not such the done deal that some had expected it might be.
Yeah, the Fed sweepstakes continue, Scott. But just getting back, I think, as usual, you're asking the right question, which is whether or not this kind of hawkish cut is really built into the market. It is undeniable that that is the pricing out there. If you look at where the probabilities are indeed placed, the probability of that second rate cut or a follow-on rate cut in January does drop pretty substantially, down to just 23% right now. And really, you don't have another cut confidently built into the market until June. April now 53%, but that's been wavering, on that 50% line for quite a bit here. It's June where you get the confidence of a rate cut. And sometimes, even though the market's expecting it, there is a reaction that is important. And there's the inflation indicator suggesting that really what's happening in bond markets now is not an inflation story. It's a term premium story. As for the interview, Scott, my understanding is that the president will start today with Kevin Warsh, and I believe Waller's on the list as well. Kevin Hassett, too, and whether or not it's Bowman or Reader or both, we don't really know, can't tell at this point. And the president says he knows who he's going to pick, but apparently going through this process here of interviewing the candidates so the president can be comfortable with him. And what's important, by the way, about the prior chart we just put up, I should have mentioned, it's June when we get the next Fed chair. So that's when the market becomes confident that there's another cut coming.
Sure. Yeah, that's very interesting that you point that out. And we need to pay attention to that as well and take all of that into consideration when you get the outlook today, too, and sort of game out how 26 looks with somebody new in the chair. Steve, I'll look forward to seeing you.
Scott, before you go, let me make 2 quick points. One is that the Fed making the forecasts today and the policy without the data. We get a lot of data next week. So that for the economy and the Fed could change dramatically next week. And one other point, which is I don't need to do this, but I want to tease your interview with Gunlack that happens after the meeting. A very important interview coming up, I want to say, for 2 reasons. One is we need to know why Jeff thinks that rates are higher, what is behind that in his opinion. And second, what he thinks of this Fed race that's out there right now in terms of who he feels comfortable as a guy that puts a lot of money into this market, who he feels comfortable at the helm of the Fed.
All right, you've got 2 of the many questions on my list, so thank you very much for teeing that up. I'll see you when you come out of the room, and we'll all discuss a little bit later. That's Steve Liesman, obviously down in D.C. ahead of that big decision.